Hello and welcome back to EverGuide Financial's Investor Education Series. Today, we're going to talk about valuation. So valuation is really another type of ratio that looks at what price people are willing to pay for a stock. So in general, higher valuation. Companies that are better managed should receive a premium to ones that are less well managed. Companies that have less variability in earnings should receive a premium. So and as an example for that is if your earnings move up and down with the economic cycle, then you should have less of a discounted valuation to somebody that or a company that does well regardless of what the economy does. And then lastly, companies that have higher future growth prospects should receive a premium to ones that do not. So let's first talk about the PE ratio, which is basically price to earnings. So it's price divided by earnings per share. This is the most widely used metric of valuation, and it shows how much someone is willing to pay for earnings. The way to look at this is you should compare it to other similar companies, but it does have the downfall in that earnings can be manipulated, and sometimes it's not the best metric for some industries. Next, we'll talk about the price to sales multiple, and this is just price divided by sales per share. And this, again, it just shows how much someone is willing to pay for sales. This is a good measure because it's tough for a company to manipulate sales, unlike it can for earnings. It's also a good measure for companies that are growing very, very quickly and investing a lot of money back into their business. So they may be growing sales tremendously, but because they're investing so much in the business, they're not profitable yet. So it's a good way to compare companies that are growing very fast. The downfall to that is you may have a company that produces a lot of sales for a long period of time, but they can never produce a profit. So there's really no room for you to actually ever get some type of return. The next one is price to cash flow. This is just price divided by cash flow per share. Again, what somebody's willing to pay for cash flow. The reason why this is a good measure because it adds back non-cash accounting charges, such as depreciation and amortization. It also is because cash is less manipulated. You can't make changes to cash. The cash is what it is. This is good for companies that have a lot of accounting charges. Think of something like a real estate investment. You buy the real estate, you take large depreciation charges every single year, but you're not actually paying anything. So there's no cash that's coming out. So it's a good measure that way. So your earnings may look negative, but if you're not paying any cash, then you're still generating money. The downfall again to this is that eventually those accounting charges have some real consequences. So the reason why you depreciate real estate is because at some point you're going to have to pay money to fix that real estate because something falls apart. And so again, at some point, those accounting charges come back and price to cash flow may miss those pieces. Next one is price to book value. Again, it's book value per share, which book value is the value on the balance sheet of the net assets. Again, this is a good measure because it shows how much a company would be worth if they liquidated all of their assets. So if you have a price to book value multiple that's less than 1, that means theoretically you could just close the business, sell everything, all the assets, and actually end up with more money than the price per share. Again, this is good for a company that has a lot of tangible assets, but again, there is a downfall and it can be distorted by acquisitions, write-offs, share buybacks. And the last one we're going to talk about today is enterprise value to EBITDA. EBITDA, again, being earnings before interest, taxes, depreciation, and amortization. So it's a form of cash flow. Enterprise value is really the price times the amount of shares outstanding plus total debt minus the cash. And the reason why people look at this is it's a good measure as for the takeover value of a company. So if you were to go in and buy this particular company, it looks at what the price you're paying. Because again, if you bought this company, if this company was a buyout, you would be assuming the debt, and you would really not be getting anything for the cash. So this helps to normalize companies with different capital structures. So some may have a lot of debt, some may have no debt, and it's just a way to normalize it. And again, the downfall here could be that it leads to finding value traps, where companies, even though it looks very, very cheap, because you're looking at it as a takeover candidate, sometimes you're missing different things like growth of sales or actual earnings and things like that. So what's important to know when you're looking at valuation, there's no set way to look at valuation, because it's a timing thing. So multiples are good to look and compare similar companies. So you don't want to compare the multiple of a software company with that of an energy company. You should be comparing software multiples, company multiples to software companies. Also, companies can stay over or undervalued for a very long period of time, because again, it goes to investor appetite. So a company that may look undervalued could stay that way for years until investors start to come back to that particular company or that particular industry. Again, valuation is best used as a measure of risk and probability. The reason why I say that is it's better to buy a good company at a fair price than a bad company at a great price. And again, that goes towards companies staying over or undervalued for a long period of time. If it's a good company and it continues to execute, you're better off owning that company and paying a little bit more for it than one that's not going to execute. And then lastly, valuations are best used at extremes. So when a company is significantly overvalued, so let's just say everybody in the industry trades at a 20 PE multiple, and your company's trading at a 80 PE multiple. Well, all else being equal, they're going to have to earn a lot more money than everybody else in their industry for a long period of time to make up for that multiple. So it shows the risk in owning that particular company, and vice versa. If you've got a company that's significantly undervalued, then the same type of thing. If it usually trades at a 20 and it's trading at an 18, that's not too much different than normal. But again, if it normally trades at a 20 and it's trading at a 10, then there's a lot less risk in buying that company, because there's a good chance that sometime in the future, it might not be in 6 months or a year, it might maybe a couple of years down the line, it should go back to its long-term average of 20. So just want to say thank you again and for listening. And for more videos, please click on the bottom right and subscribe.